Hey guys, candlestick formations are the most important price action signals you can find on any price chart. Candlestick patterns express various messages and can tell us a lot about what supply and demand are up to. Understanding these patterns allows you to read the next move in the market, and it will help you to make the right decisions. No matter what your trading plan is, applying the candlestick concepts on the chart will improve your win rate. However, the majority of traders do not use the candlestick techniques correctly. In this video, we will show you some of the most interesting candlestick patterns along with the psychology behind them that will change how you see the chart. Then we'll explain how to combine these patterns with other price action trading tools, including key levels of market structure, retracement levels, trend lines, and confluence areas. So guys, if that's something you're interested in, as always, please hit the like button to help us make more videos like this, and subscribe to our channel if you're new. See you after the intro and disclaimer. First of all, why candlestick formations are important. The candlestick formations are the early and leading sign of what buyers and sellers are doing right now in the market, which allows us to anticipate their next moves. However, these patterns alone may not make much sense without additional confirmations. To use them effectively, it's important to combine them with other tools like key levels and confluence areas, which we will explain later in this video. First, let me show you a list of the most interesting candlestick patterns that work very well. There are many candlestick patterns that traders use, but the ones we find most effective are those that happen most frequently. Let's start with the first one, a long wick rejection. As the name suggests, a long wick rejection is a candlestick that has a long wick and a small body rejecting a certain price level. This is a reversal pattern, which means that whenever this candlestick forms, we expect the price to reverse from the current market situation. We have a downward movement, the long wick rejection forms, and price reverse. The candle's color does not matter. It can be red or green. From the price action view, the sellers have failed to close another strong bearish candle, which shows momentum loss. On the other hand, the buyers have stepped into the market and immediately pushed the price higher. This rejection signals a possible reversal to the opposite side of the market. Same thing here. The price is pushed up, hit, and reversed, forming a long wick rejection pattern. Again, it shows that the buyers are losing momentum and sellers have stepped into the market, which makes the price reject this area, signaling a possible reversal to the downside. Now on the real chart, we have Eurodollar in the 1-hour time frame. The price has pushed down, forming a long wick candlestick rejecting this key area, and then the price has immediately reversed. As we mentioned earlier, the candlestick formations are strong price action signals. However, they cannot be used on their own but combined with other price action tools. As we witnessed in this example, the support and resistance areas are one of these tools. You could even combine them with smart money concepts, which I will show you later in this video. Multiple rejections. This pattern consists of multiple candles rejecting an area by wicks. Here on the chart, the price pushed down, hit, and drastically reversed, giving us a key area of support. As the price returns to this zone again, we can see that we have multiple long wick formations in this area rejecting this price. This shows the sellers have tried over and over again to break the price to the downside but failed. Whenever the price has gone below this level, the buyers have entered the market, causing multiple wicks, which presents a trading opportunity. Here in the opposite direction, we had a key level of market structure acting as resistance several times. When the price returned to this level, we had multiple wicks sticking out and rejecting this area. Once again, it shows that the sellers held this level strong and confirmed the reversal. Momentum candlestick. The momentum candlestick consists of two consecutive candles with the same color where the second candle's body is bigger. From the price action view, it indicates an increase in momentum, which signals movement continuation. Here, when the price reached this level of market structure, first we had multiple wicks rejecting this area, followed by a long wick candlestick, which shows that sellers were unable to push the price lower, and the price immediately pushed higher. Then we have a momentum candlestick formation, which shows that the buyers have entered the market, and the price has gained massive bullish momentum. Now price can continue to push higher, which provides us with a perfect trading opportunity. Now here is a pro tip. In the bullish scenario, If the second candle has no wick on top, it indicates that the buying pressure was present until the end of the candle, which is another sign that the price will continue pushing higher. The same thing for the bearish scenario. The absence of a wick at the bottom of the momentum candle signals massive selling pressure. When important news comes out in the Forex market and other price charts, it can cause sudden and big momentum candlesticks, regardless of the technical situation. So it's smart for traders to stay informed about upcoming economic news. If you're curious about how we stay updated on financial news and fundamental analysis, well, we rely on Fastbull, one of the best trading websites with various useful trading tools. This site provides one of the most accurate and detailed economic calendar, a tool we use every day before starting our technical analysis. 24/7 economic live streaming also allows us to stay informed about the latest trading world's news and fundamental analysis. So if you want to benefit from multiple trading tools that can significantly improve your trading, make sure to check the link in the description. Now let's move on to the next pattern. Number 4. Shrinking candles. Shrinking candles refers to a situation in which the candle's body is getting smaller and smaller before reaching a supply or demand zone. Here on the chart, the price came up, hit, and reversed, giving us a key level of resistance. Notice how the candle's body gets smaller as the price approaches this level. The psychology behind the shrinking candles is that it shows the loss of momentum from the buyers, which results in a smaller distance pushed by the price. It is an early signal that buyers are losing control, and prices might reverse from the area. Now this pattern works best when accompanied by another reversal pattern, like a long wick rejection at the end. Remember, the same concept is valid for the bearish scenario. Number 5. Engulfing candlestick. Engulfing candlestick formation is one of the most powerful price action reversal patterns, which I'm sure you have all heard of. This pattern consists of two candlesticks in which the body of the second one has an opposite color and engulfs the body of the first one. Forming this pattern at the bottom of a bearish movement indicates a reversal to the upside. Forming at the top of a bullish movement indicates a reversal to the downside. Now, this would be all of the candlestick patterns explained in this video. Now, in the second part of this video, let me show you some of the price action tools that work perfectly with the candlestick patterns. Number 1. Fibonacci retracement levels. Imagine if we have an uptrend with a series of impulsive and corrective moves. We have identified the most recent impulsive move and waiting for a pullback to go long at a better price. So we grab the Fibonacci retracement tool. Simply click on the start of the impulsive move from the bottom of the wick, and then drag the tool to the top of the movement. You will then see the retracement levels appear to the right. When price pulls back to these levels, they can act as a form of support and potentially reject the price to continue moving upwards. This is a great way to identify the end of the pullback and the start of the next impulsive move to the upside. But here is an important point. The range between 0.618 and 0.786 is referred to as the Fibonacci golden zone. This zone is a significant area for identifying potential support and resistance levels during price corrections, and also provides a reasonable risk-to-reward ratio trade. Now, the best way to combine this concept with candlestick patterns is to wait for the price to tap into the golden zone and look for price action signals through candlestick formations. But remember, before you start making trades based on any idea, it's important to backtest it with a couple of months' worth of data to see how well it performs. We have a clear impulsive movement to the upside, breaking above the previous market structure. So let's apply the retracement tool from the start to the end of this move. The area between 0.618 and 0.786 is our golden zone. If the price manages to return to this area, we will closely monitor the price action signals through candlestick formations to look for a long trade opportunity. Now let's see what price action signals we get. Here we have a momentum bearish candlestick followed by an indecision candlestick. The indecision candle shows that the bulls and bears are fighting to take over control, but the price finally closes in the middle of the candle making wicks from both sides. Now, in the following, we have a large bullish engulfing candlestick which signals that the buyers have taken control and price can potentially start to move to the upside. Now, the important point here is that all of these price action signals and candlestick patterns have formed in the golden zone. However, if we open a long position right now, we would have a very large stop loss, and our risk-to-reward ratio will be less than 1 to 1 when we reach the first target in front of the price. So we have to wait for some kind of a pullback to enter at a better price. To identify the pullback, we can zoom into a lower time frame and apply the retracement levels one more time. Here on the 15-minute chart, we consider this as the latest bullish movement and apply the retracement tool. This area is considered the golden zone and potentially provides us with a perfect trading opportunity to go long. Let's continue with the second price action tool, a major level of market structure. A major level of market structure refers to a level that has been rejected multiple times, acted as both support and resistance, and has recently been respected. For example, here, this area has been rejected multiple times recently, and it has acted as both support and resistance. When the price returns to this zone, this is an excellent opportunity to look for short entries. We will closely monitor price action signals and candlestick patterns to get our entry reason. For instance, forming a bearish engulfing candlestick pattern in this zone can be our entry reason to go short. Number 3. The trend lines. A trend line is a line that connects the swing highs and swing lows in the trending market. So here we have a series of impulsive and corrective moves creating an uptrend. Now a trend line is applied to connect the swing low along the bottom. In the bearish scenario, a trend line is applied to connect the swing highs along the top. Why do we draw trend lines? The first reason is trend lines can act as a support or resistance. The second reason we draw trend lines is that breaking a trend line can signal a possible trend change. Here is an important point. We don't enter trades just because the price touched a trend line and it can act as support or resistance. We always wait for price action entries in combination with other factors, which we have discussed earlier in this video. Now let's discuss the best way to draw a trend line. There are important concepts you need to follow when drawing a trend line. Number 1. Try to draw the trend lines from the wicks rather than the body. Number 2. Adjust the trend line to get the maximum number of touches. Number 3. Do not force the trend lines. If they are obvious and help you with your overall analysis, draw them. Otherwise, do not try to draw a trend line in any market condition. Now, with all being said, let's see some chart examples and combine the concepts of this video. Here on the gold 1-hour chart, we can draw a very clear trend line like this. The market has broken the trend line to the downside, which is a bearish signal. If we zoom into the latest area to observe the market condition, we can see that we have a strong area of resistance. Just look at the long wick rejections here. So now support turns resistance and potentially provides us with a trading opportunity. Now as we approach this level, we have shrinking candles showing a bullish momentum loss and a long wick candlestick formation rejecting this area and the back of the trend line, which is a great sign to open a sell position at this level. Here, on the Eurodollar 1-hour chart, we can identify a major level of market structure that has acted as support and resistance multiple times. Also, we can draw an obvious trend line by connecting the swing lows. The intersection of the trend line and the support zone is an important level because many eyes are waiting to enter a trade in this zone. First, we had this indecision candlestick showing that the buyers and sellers are fighting to take over control, but the price finally closes in the middle of the candle, making wicks from both sides. Then we had a large momentum bullish candlestick, which is a signal that the bulls have taken control, and price can now start to push to the upside. So guys, that's it for this video. I hope it had some value for you.